Okay, RTX Q3 results are out. Strong performance, updated outlook. Let's dive in.
Yep, the mission is clear. Unpack the numbers, see what's driving growth, and look at that raised guidance,
All right, straight to the top line. Q3 sales, $22.5 billion.
which is 12% up year over year. But organically, it's 13%. That's the real number to watch.
Double-digit organic growth right out of the gate. Sets a strong tone.
Absolutely. And then look at the earnings per share. Adjusted EPS hit $1.07.
Which crushed the consensus, right? What was it, $1.41?
Exactly. $1.70 versus $1.41. That's a 17% jump from last year. It's not just sales, it's efficient operations too.
Yeah, you can see that efficiency in the cash flow numbers too. Free cash flow. Well, it basically doubled.
$4 billion. That's a 104% increase. Huge. Shows they're managing working capital well.
So, well, in fact, they felt confident enough to raise the full-year forecast pretty substantially.
Yeah, you don't always see that mid-year in this sector. New adjusted sales target is $86.5 to $87.0 billion.
Up from around $85 billion before.
Correct. And they pushed the organic sales growth expectation up too, from 6-7%, now it's 8-9%.
And that flows down naturally. Adjusted EPS guidance is now $6.10 to $6.20 for the year.
Yep. Higher revenue, higher profit expectation. Though, interestingly, they kept the free cash flow guidance the same, $7 to $7.5 billion.
Oh, that is interesting. What do you make of that?
Well, it could mean they expect profitability to improve faster, but maybe they're also planning for, more investment. Perhaps building inventory to handle that huge backlog we need to talk about.
Good point. CEO Chris Callier basically put it down to strong execution. Said they had double-digit organic growth across all three segments.
And they mentioned this is their 6th straight quarter of segment margin expansion. That's consistency.
Definitely signals good underlying health if they can grow margins while ramping up. Okay, so let's break down those segments. Where exactly did that growth come from? Starting with Collins Aerospace.
Right, Collins. Avionics, interiors, engine parts. They pulled in $7.621 billion in Q3 sales. That's 11% organic growth.
And the drivers there, commercial aviation bouncing back.
Yeah, big time. But it's balanced. You've got strong growth in new equipment and in keeping older planes flying.
So the commercial OE original equipment that was up 16%, mostly narrow bodies, I assume, A320s, 737s.
Exactly. Airlines want those new fuel-efficient planes. But the really juicy part is often the aftermarket.
Right, parts and repairs. How did that look?
Commercial aftermarket was up 13%. That's parts, repairs, retrofits. It shows planes are flying a lot globally. It's usually higher margin stuff too.
And they locked in some of that long-term aftermarket work, didn't they, with Japan Airlines?
They did. A big one. A new 10-year contract for MRO maintenance, repair, and overhaul on JAL's 787 fleet. That's a solid revenue stream.
Okay, so Collins is strong on components and interiors. What about the engines themselves, Pratt & Whitney?
Even stronger growth there, actually. Pratt's Q3 sales hit $8.423 billion. That's up 16%, both overall and organic.
16%. Wow. Where did that come from?
It was firing on both engines, pardon the pun.
Yeah.
Commercial and military.
Okay, commercial first.
Commercial aftermarket was huge, up 23%. Mostly large commercial engines needing service. Plus, Pratt Canada did well. When an engine needs work, you pay up, right? That 23% shows that demand.
No kidding. And the military side at Pratt?
Also very strong, up 15%. And that was really driven by one program, the F-135.
The engine for the F-35 fighter jet.
The very same.
Yeah.
The growth came from higher volume tied to that big Lot 18 contract award that was, $2.8 billion just for those engines? Geopolitics driving demand there.
Okay, Collins and Pratt driving strong commercial and military growth. Let's round it out with Raytheon, the defense system side.
Raytheon reported $7.045 billion in sales. Also strong, up 10% organically.
And the drivers, missiles and defense systems.
Pretty much. Higher volume on land and air defense systems. Think International Patriot missile defense sales. Also growth in naval stuff like SM-6, Evolved Sea Sparrow, and some classified programs too.
You mentioned urgency earlier. The Raytheon contracts really seem to show that.
Absolutely. They got the biggest AMRAAM award ever in the program's history. Lots 39 and 40.
AMRAAM being the standard air-to-air missile.
Right. Used by air forces everywhere. And it adds to their already massive defense backlog. Raytheon alone is sitting on $72 billion. Big chunks are GEM-T missiles, that AMRAAM award, LTAMDS radar.
So bring it all together, Collins, Pratt, Raytheon, all growing double digits organically.
And translating to the bottom line, adjusted segment profit across the company was up 19% year over year. They mentioned their core operating system helping there.
Right, their internal efficiency program. Seems to be working, helping margins even as costs rise. So this isn't just a one-off good quarter. That demand seems locked in, right? Look at
Yeah.
the total backlog.
It's staggering. $251 billion for the whole company? That's years of work already booked.
251 billion. How does that break down? Commercial versus defense.
It's roughly $148 billion commercial, $103 billion defense. And they're still adding to it rapidly. $37 billion in new awards just in Q3.
$37 billion in one quarter.
Yep. And over $8 billion of that was just munitions orders.
Yeah.
Countries are clearly restocking and upgrading. The demand wave isn't slowing down yet.
With a backlog that huge, though, the challenge becomes execution, right? Delivering on all those orders.
Exactly. That's the main focus now. Management talked about leveraging scale and innovation. On the scale front, they're putting money down $300 million this year just for capacity expansion at Raytheon.
Building out the factories to meet that defense demand, especially missiles.
You got it. They need to ramp up production quickly for things like Patriot and AMRAAM.
But it's not just about churning out current tech. They're still investing in the future, particularly on the commercial side.
Definitely. They highlighted work on a hybrid electric propulsion demonstrator. That's for regional aircraft.
Hybrid electric. That's about fuel efficiency and noise, right?
Primarily. Big potential savings for airlines if they can make it work. It's a long-term play, but crucial for staying competitive.
And smaller innovations, too. Something about brakes.
Yeah, using proprietary carbon technology in the brakes for the A321XLR. Carbon brakes are lighter, last longer.
Lighter means less fuel burn. Longer lasting means less maintenance. Ties back into that aftermarket story.
Exactly. It's those continuous improvements that add up.
And wrapping up the financials for the quarter, they managed their capital well, too.
Seems so. Returned about $2.9 billion to shareholders, but also paid down $2.9 billion in debt. And they completed selling off that Collins actuation business. Just streamlining things as they prepare for this production ramp up.
Okay, so summing it all up for you listening, RTX posted a really strong Q3 2025. They beat expectations significantly on sales and earnings per share.
And that confidence translated directly into raising their guidance for the full year. It feels sustainable because it's backed by that massive $251 billion backlog showing huge global demand.
Demand coming from both defense, think F-35 engines, missile systems, and the commercial side, especially that high-margin aftermarket.
Right. Which leads to the final thought we want to leave you with. You have this immense urgent demand for defense production now, but you also have to keep investing heavily in long-term, expensive R&D for things like hybrid electric flight for the commercial future.
So the question is,
how does RTX effectively balance those two demands? Meeting the urgent need to build and deliver defense systems today, while simultaneously funding the innovation needed to win the next generation of commercial aerospace tomorrow. Managing that tension will be key.